want to give thanks to our partners. First, most importantly, First Republic. There he is, Robert the man. Robert with the hair, unbelievable. Listen, if you're VC or a startup in tech, anybody, bank with Robert. Most important part of the night right now, the sheets in front of you have a code, and that's going to be for voting. But if you flip it over, it has everybody's Twitter handle, right? And there's a QR code on the Twitter handle. If you see that, QR code that Twitter handle. You see Robert's right there, and please connect with Robert, or we can't do this again. You know, it's not true, but you know. Shameless plug. We got to hype up Twitter and Rob here. Good. And Dina, I don't know where you are. I love you. Dina, we're not there yet. Dina's got the after party at the Folly, which is on Houston at 8:15. So as soon as we're done here, we're gonna go over to the Folly. Dina is the best at picking out the spots. Louis, great hair. You're doing a good job. All right, great. I think we knocked that out. Is Kyle here? Nobody else? That's all right. All right. Yep. Sorry, Kyle. Pitch Pages. Yeah, it's all right. Pitch Pages sponsored right here. Tyler, the founder of Pitch Pages. Fastest way to turn your pitch deck into a smart web page. Share, track investors, manage your digital deal room. Tyler's like wrote all the questions. He's very smart. They're very detailed questions. I'm probably going to stumble over my words, but it's all right. Good job, Tyler. HQO, that's where I work right now. Prop tech company. Yes. Premier workplace experience. We're basically building out an app for corporates so that they can add hot desks, conference rooms, communication, all that good stuff. If you're a big corporation, would like to do that with you, or a landlord, that's what we're building. Bringing people back to the office. IBM Accelerator is not here tonight, but we're going to be doing some stuff with them later on. So they have an incubator. If you want some information on that, let me know. Follow up with me on that. And I think they close out next week. So happy to connect you with the IBM team, Hyper Protect Accelerator. So that's going to be a nice partnership. We're going to try to push that along, get you guys, involved with IBM and us too. Entra's been a part of the Entrepreneur Network for a while. JoinEntra.com. They got a nice little app where entrepreneurs connect. JoinEntra.com. We're going to be doing an NFT NYC, let's say, happy hour, rooftop happy hour on Tuesday, June 21st. All welcome. It's going to be at Mr. Purple on the Lower East Side. So if you want to be invited to that, just follow up with me. You want in? Yeah. All right, good. I think that's it. We're going to bring up the VCs. Let's give them a round of applause. VCs, come on up. Nihal, come on up. Taylor, Dahavia, Jason. So as they come up, listen, this is how it's going to work. We're going to ask them 4 questions. After every question, we have that QR code, and that's the audience fan voting. So we're going to stop, open up the polls. You're going to vote who won that question. 2 people get cut after those 4 questions. 2 make it to the finals. After that, somebody's awarded this PrimeTime VC belt. It's coveted. Nihal has one. You do get to keep it. Robert's going to send you even a... This is a stand-in. It's engraved. It's unbelievable. As long as you tweet it out. So we got that. I'm going to go down the line. We're going to go right down the line. We're going to talk about the fund that you're involved with, the thesis, the seed, whatever you want to talk about. I'll give you 1 to 2 minutes on your fund and yourself. But Dahavia, why don't you start off?
Yes, thank you. Hi, everyone. I'm Dahavia Stewart. I'm an early-stage investor at Anthemis, which is a fintech-focused fund based here in New York City, where we invest from pre-seed to Series A. Right now, we have about $1.5 billion in AUM. And we're investing into North America, Europe, Latin America, and also the African continent.
Hey everyone, that's loud. Hey everyone, my name is Jason Scott. I'm wearing a couple hats today. So I launched my own fund 15 months ago called Anim. It's Latin root for to bring spirit to, animate. We invest globally, currently have 21 investments across 5 continents. And then secondarily, one of the founding members of the Black Angel Group at Google, a group of Black angel investors around the world who invest in pre-seed seed companies across also 6 continents. So.
Awesome.
Hi, my name is Taylor Brandt. I'm an investor at Headline, which was formerly known as e.ventures. We're a multi-stage fund, seed through Series C globally. We have teams across the world. I'm on our U.S. Early stage team, primarily writing checks seed through Series B across. And so we do almost every sector, but I personally primarily do vertical software, horizontal software. Yeah.
And shout out to our host, Nihal. This is his office, ENIAC's office. So let's give it up for him, right?
Thank you for coming. I've got a home court advantage, so I better take home another belt today. Co-founder of ENIAC. So ENIAC is a pre-Series A institutional VC. We write $1 to $2 million checks pre-product market fit, help the companies get through product market fit, and then convert to the A. At the A, we're usually coming off the board, where it's still doing the pro rata through the B, but we're really laser focused on that C to A stage. Been doing it 12 years. Some of our hits include Airbnb, Uber, Attentive, Boxed, although Boxed is down 80% today. So maybe I'll remove that from the intro. Owlet, Alloy, the list goes on and on. But thanks for coming to our office.
Awesome. So now we're going to have the VCs debate a little bit. Everybody's going to get a chance, about a minute or so, and then we'll open up the polls and just get this show started. All right. Most electric show in venture capital entertainment. You don't like that, Robert? No pressure. All right, first question. Apple just announced this week a dozen new features that should be concerning to a number of tech companies. Lots of chatter on Twitter from investors like Bobby Thacker at Share Ventures, who thinks Apple just killed a number of companies, including Square, Klarna, Affirm, Transit App, I'm gonna mess that up, good. Google, Photos, all car software, and any health app. So that's a lot.
Don't sue the company.
Could be disruptive. Nihal, I'm gonna start off with you. What did he miss? What impact will this have on the startup landscape?
I don't think that much, to be honest. I'm going to be a little contrarian. You know, like 10 years ago, when I was a founder, people were like, oh, what if Google does it? I'm like, actually, I hope they do it, because that validates the market. I don't think that it's really going to make that much of a difference to any incredible founders. Now, pre-existing products like Tile, for example, might feel a little pressure from AirTag. But in general, like Square, Klarna, these companies are not going away.
Taylor, over to you.
Yeah, I'll definitely echo that. I think that when you've already put in infrastructure in place around buy now, pay later, you're probably not ripping and replacing. Also, Apple Pay still isn't that adopted like it should be. App Clip should have more effect. NFC at this point should have been more adopted, but it hasn't been. So like there's still the majority of wallet share that isn't going through Apple today, even though like they are a finance option. So.
All right, hot takes over here. Dahavia?
Sorry, I have to agree with them. I guess like from my perspective, when we think historically, when Apple has entered the market where there were like large or fast-growing tech companies. For instance, a few years ago when Apple rolled out Apple Cash, in which it competed directly with like Cash App and Venmo, the same concerns were there. But then, Cash App continued to grow from like 26 million users that year to about 36 million the next year. And so I would have to agree with them. And then we also think about Android users, it's about like 1.8 billion of them globally. And so it's still like a lot of market share available.
Dropping stats and facts, I like that. Jason, they left it wide open for you to go the other way. What do you think?
Well, I think you're just going to have an agreeable panel today, so I don't know. Well, first and foremost, I'm clearly biased as a former Googler, but I agree with what you said. First and foremost, I think if you look at globally, I think the biggest opportunities are actually outside of the hubs of Silicon Valley, New York, London, and so most of those users are actually on Android or not even on iOS or not even using Apple products. I think secondarily, I think from a founder perspective, I think it's actually validating to see that a company like Apple is actually moving into those spaces, because I think for most of my founders, I tell them a viable exit strategy is also to be acquired by some of these and get on the radar of some of these big tech companies. Google acquires companies daily that actually make a lot of people incredibly wealthy and create a lot of generational wealth for themselves and their families. And so I actually think it's a great opportunity for a lot of founders. And so I think we're all just going to agree, and all four of us have to move to the next round.
Boo. Boo. All right, let's open up the polls. I feel very short in this chair. I'm going to move
I mean,
this
I can
over.
disagree for the sake of
So
this.
scan, yeah, no, I'm going to let you disagree. Scan the code in front of you. If you guys in the front row, I guess don't have it, but that's all right. There's the code right there. Scan it. Vote for who you think won this. But I guess disagree. Give me something to disagree to. Like, go the other way. Or what are you most excited about? Somebody. I don't know. Take the round. Nihal, you know how to take a round. I don't know. Somebody jump in here.
Well, I think one is, by the way, you got it. Those are my kids in the background, so I get some benefit for your votes that are coming in right now. You can vote for the kids. Vote for the kids.
I have a really cute puppy. She's not here, but I can show you photos.
Vote for the puppy. I was just going to tell a quick story. Like my very first angel investment was a company called AdMob, and until Google launched their own ad network and failed at it, did they then, to your point, they then got acquired by Google for $800 million, right? Because Google realized how hard it was to actually build and how bad they wanted it. So I forget, you're the one that said that Apple would basically buy, right?
I said that's a viable option
Yeah.
potentially for these founders, right? And so I think ultimately as a founder, I'm looking for validation that what I'm working on is something that is going to create value for the market. And so I think if I see Apple doing something, I don't think of it as like a threat per se. I think of it in some ways as validating that I'm actually working on something that users want and that's worthwhile, and that Apple is potentially threatened by what I'm doing, right? And so that's just my opinion. Sorry, I
Also,
talk
these
fast,
are
I
not winner-take-all markets. Like, there are industries that are winner-take-all markets. This is not one of them in almost any of the categories. They're looking to just expand wallet share of the customers they already have and take small percentages from these other folks. And yeah, maybe they lose small percentages and they still grow quickly.
Tyler has the points over there. You usually text me. I'm on airplane mode, so you could just go ahead and tell who won. Dehavia, all right.
Good work.
Newcomer, there we go.
I have to say she has notes, so.
Most
Well, we got
prepared.
the questions at
Don't hate.
Wins most prepared.
Yeah, don't hate. It's all
Wait,
right.
did you guys distribute the questions beforehand?
Yeah, you were on the email.
Yeah.
A lot of excuses coming over here, you know? All right, 1-0. Actually, 1-0-0-0. You guys all have 0 points. Congratulations. Next question. Bird is the latest casualty of the layoff trend, planning to cut 23% of its staff. This is part of a larger trend as 16,000 tech workers lost their job in the last month as companies prepare for the worst in an uncertain funding environment. What type of conversations are you having with your founders regarding cutting staff or attracting talent that they wouldn't typically be able to afford? You won the round. You kick it off.
Yeah.
You get the mic on? You good?
Yeah, so I think that, I guess like one thing to think about is like the public market impact.
Yeah, hold it close, I think.
Oh, okay. I guess one thing to think about is the public market impact on private markets. Typically, it's like a 6-month cycle, a trickle-down impact on, what is happening in private markets. And I think we're starting to see that in terms of like the recent layoffs with, companies looking to decrease their burn to increase their runway. And so one thing that I think is interesting from data that I've looked at is like the difference between like the top 5 software companies last year versus this year. Snowflake being like a good example. Last year, their multiples were like 70x revenue multiple, 70% year-over-year growth. But now their multiples has decreased a lot, like to about 20x with around 70% growth. But one thing that has changed about their profile is like now they're EBITDA positive. And so I think that the way that companies are being valued is different. Last year it was mainly off of growth. Now growth is very important, but then also profitability. And so I guess I say that to say that I would say for startups, regardless if you are looking to hire someone or do layoffs, like thinking about like what is my path to profitability, I think that's something that's really important to consider.
Jason?
Yes, I mean, I think more tactically. So I think if for my founders that are actually looking to grow, I think being able to capitalize on this is a time where not just, it's funny because last year we were talking about the big kind of exodus from tech. And so I think one thing that became true even for companies like Google is that a lot of folks realize that they're searching for more than just a paycheck in their jobs. And so I think it's a great opportunity for my founders that are in a position to grow, that did raise capital before the markets kind of started to go downward, to capitalize on those people who are in search of something, of a job that creates more meaning for them, right? More value, whether it is in the mission that they're doing or the problem that they're trying to solve. On the other side of the spectrum, I've personally been a part of layoffs when I'm a high performer, and I think there's a way to do that with grace and with poise that allows those employees to still be your biggest advocates and your biggest allies and kind of continue to push your brand in a positive light. And so I think founders just have to be really intentional around how are they also making sure they support those those employees that are in those periods of transitions to land softly and land somewhere positively so that they can continue to be advocates for your brand and advocates for your company and users in the future. So,
Nihal, what are you telling the founders?
You know, in general, it's interesting. We built companies, you know, in '01 and '08, so we kind of have that muscle memory. I think, in general, it's 2 years of runway, you know, 24 months right now. So put a little bit more cash maybe on the last round, like reopen that note or reopen that valuation if you can. That's like the generalization. But like, to be brutally honest, it's a very case by case basis. It's completely custom. In some cases, companies can't raise. They have to make cuts to get the 24 months. Now, if that company is in a very competitive space, that could basically kill the company. Like the second you're cutting salespeople, marketing folks, like when the market comes back, all of a sudden your competitors are like light years ahead. So it's a real case by case. We take it very seriously on a case-by-case basis. And when this all went down like 2 months ago, 7-8 weeks ago, we sat down with every founder and we basically set up a plan. And the good news is like most of them raised like monster rounds last year, right? Like most of the larger companies took advantage of the market last year. The bad news is the burn rates were out of control. They were all going to go back this year. And so it's like, all right, we got to make some changes. We need 2 years.
Taylor?
Yeah, I think the contrarian opinion here is that for founders that I think were running companies with the right burn set, nothing should change. I had companies that I sat down with and said, run faster. You were already under capital, like you raised a large A and you've continued to keep your burn low. Many founders, it took this to just like hear that.
He's trying to get that vote for you.
oh yeah,
Bring him back. Bring him back.
You got a heckler. I like that. You planned that. You know you planned that, Nihal.
I think when you're a founder that was in a small camp of founders that get to raise a ton of capital and be and like probably raise ahead of what your valuation should be. You need to be grateful for that and also like plan accordingly. I think that people overshot that a lot and immediately hired past where they were as businesses. And so I think if you were running, I think this is actually an amazing time to be an early stage founder. I think ultimately, yes, is there like slight like frenetic energy in the space right now? Most of these funds have already raised capital. They are going to need to deploy capital. We will come back from this cycle. And companies that grow well will still get funded. So like you still need to grow responsibly. I would say that should have always been the case.
But I think so true. But I also think that you can be a capital efficient company and still be impacted by externalities that cause you to need to make cuts, right? And so like same thing happened when COVID happened. There are certain businesses that were awesome businesses, but then COVID just made them irrelevant. And so I think you still have to prepare for those cases, scenarios of how do you cut staff in a way that again can protect your brand as an employer and protect kind of your reputation as a founder, right? And so I think you should always be thinking about how to continuously be capital efficient and adapt to the current state of the market and the current state of the world.
And go start companies. Some of the best companies were started out of 2001 and 2008. So
That's right. That's right. We're going to open up the polls. Don't get swayed by the cuteness up here. This is definitely a strategy to pick up a point. Dehavia, do you have anything else you want to add in here? Well,
I thought you were.
Or Jason, I don't know.
I thought you were cutting the.
No. Polls are open. But how about, attracting expensive talent? I don't think we really touched on that as much. Anybody opinion with that?
Yes.
Jump in.
it's a great. Can I talk? Can I talk, please? It's a great time, like to hire great VPs because they're on the market.
Yeah, like find the people that you admire in the spaces you know, the people who know those spaces, and look at all their. And even if they weren't let go, if they just saw a slew of layoffs within their own orgs, they're probably a little like, yeah, this is a good time to go after them.
Oh, I was gonna say, I feel like a lot of people that may have been laid off recently, whether they were top performers or not, they may be more weary in terms of taking jobs at startups just because, of the environment, and may want to, pursue like more stable companies. And so that's also something I think we should consider.
And I think a lot of founders tend to think in times like this that they can maybe get a deal on an employee. And so I think like don't fall victim to trying to pay someone less just because we're in a downtime or they lost their job, right? And so make sure you still acknowledge the value of those employees. Sorry, he's the cutest thing.
I think the polls are closed. Tyler, what do we got? I like you being a little more vocal and telling us who won. Taylor, there we go. Taylor. We got an extra mic?
We can also project. Yeah. We're good.
Okay, it's me.
All right, here we go. Next question. All right, moving on. 1-1. 0-0, you guys, sorry, but you got to step it up if you want to get in the finals. And it will be percentage-based, so Tyler will tell us who made it into the finals. Question 3, there's been a number of non-dilutive funding companies that have entered the market in the last few years. Are these viable options at all for early-stage companies? And what's your general opinion on their role in the funding landscape? Jason, go ahead. You need this. You need this point.
Do I need it? No. So for sure. Okay. I think generally, I do want to go to bed. I think generally non-dilutive capital obviously is something that can be a game changer for so many founders, particularly founders that don't necessarily have the networks, the friends and family rounds, the networks within the venture ecosystem. I invest a lot outside of the Bay Area, New York, and those founders don't necessarily know how to access venture capital, so having the bridge is helpful. But what I will say is, if you are kind of pre-product market fit and you're looking to go into something like revenue-based financing, then I think you are not necessarily ready for those types of sources of capital, because you need to be ready to be able to put hit that inflection point of growth, I think, before, if you're going to things like getting debt financing or venture debt or revenue-based financing, in order for that to actually be a valuable model for you. I think if you are pre-product market fit, then going for non-dilutive capital sources like grants or, I don't know, even pitch competitions could be something more viable for you. So I think it depends on your stage as a founder, personally.
Dahavia?
Yeah, I would say for the most part, I definitely agree with that. I will say that I've seen players like Silicon Valley Bank who are going a little earlier with pre-seed and seed startups, and so it does seem like that can be an option for them. I do think that given the public market impacts on startup companies, that it is more risk with, I guess, underwriting pre-seed and seed startups for venture debt, just given that most of these loans are based upon being able to raise capital in the future. And so I think the impact would be like a smaller deal size than what we've seen last year in terms of like being able to raise venture debt, for instance.
Nice. Taylor?
I think that venture debt is best suited for, one, revenue-based, and two, like inventory financing and things that like ultimately like venture doesn't like, those are things that can be funded through other sources. If you are, if that's not venture is just used to fuel your business growth, and I think there's like lots of ways to offset that. I also think there's lots of opportunities for companies that aren't just venture-backed companies, and so getting to a place and giving yourself optionality as a founder, like breakout companies will still be breakout companies if you decide later you want to raise venture. Does that sometimes make it harder? Yes, but it can be an amazing opportunity. Like great breakout companies are found by venture capitalists eventually. So, like I think it's definitely a viable option, but I think in the earliest stages, it's hard to find that. Also, the capital structures are going to get tougher because debt like the interest rates are going to rise, and that's going to become more difficult.
Nihal, you don't have your sidekick right now, so pressure's on.
Yeah, if you can get it, take it, and take it and run, basically, because, these options were very plentiful last year in a great market. And I think to your point, Taylor, the rising interest rates, like a lot of these companies are not going to be able to offer the same types of terms and lines and options. You have Clearco and you have Pipe and there's like dozens of companies in the space, not to mention the traditional FRB, SVB, WTI, et cetera. So if you can get it, take it and run. I think the companies that took it last year, by the way, the counter is, and companies that go out of business in the next 12 to 18 months end up having like this crazy debt that's now at the top of the stack. But I think in this market, you should take it and run.
All right, we'll open the polls. The funding landscape, anyone want to touch on that as well? I mean, we touched on it a little bit, but did we miss anything? Taylor, jump in.
The like venture funding landscape?
Yeah, I mean, that's part of the question.
I think that the venture funding landscape, like as I touched on previously, like most of these funds, like a lot of like repeat funds, have already raised forward-looking funds or are in the process of or are close to closing those funds. So I don't think that in reality those funds will stop deploying. Will they be more cautious in deploying? Will they probably be less aggressive in deploying? Probably. But at the end of the day, like a lot of funds raise larger funds, including my own. Our goal is to write those checks. And at the end of the day, venture is like, we're living on a cycle. Like, yes, there's going to be no liquidity at the top of the market, but all of us are early stage investors. There's going to be plenty of time before that liquidity event. What we are waiting for is for step-ups in valuations and making sure that people don't run out of cash. So just making sure that you have cash to go execute.
But I think, sure, I think that really applies for a lot of founders based in, again, Silicon Valley, New York, London, et cetera. But when you say investors are going to be more cautious, I think that translates to investors taking fewer risks. So a lot of the investors that would have potentially invested outside of their standard geographies, outside of their standard networks, and particularly in underrepresented founders, you're going to see, and we have seen, for instance, the numbers of even women-founded companies getting investment over the last 12 months has started to actually go down as a proportion of the overall venture capital ecosystem. I think that actually becomes a concern for founders that have traditionally lacked access to the venture capital networks that are outside of either the networks, the regions, or your standard profile of a founder. And so I do think it applies to certain groups of founders that are not part of the.
I don't disagree. Like particularly, like I almost invest non-coastally, but I invest post-product market fit. So I think like to the other folks in the room, like at the end, like it continues down the stack. Yes, if they're not getting pre-seed funding and seed funding, it becomes much harder. But ultimately, are looking for like performance.
It's good banter. That's what we want, the banter, all right? More banter, the better. Tyler, who won this round? Nihal. Jason.
Did it without
I guess
the
I'll go
kids.
home, team.
Listen, he does have a dinner
Did it on
after
my
this. He
own.
did say he's got dinner, so maybe he's tanking it. We got one more question. You could get a point. Again, this is all based off percentages, so Tyler will give us the winner. And again, last round before 2 VCs get cut, which just means they move to the outside. And we'll go on. All right, here we go.
I mean, I get pizza, so I guess it's good.
You're just trying to go to the open bar a little early. I get it. It's all right. It's fine. All right, last question. When it comes to early stage startup valuations, you've heard many of you heard the old saying, it's more of an art than a science. Even though the process at this stage is more qualitative, have you developed any kind of quantitative methodology in assessing what a company should be worth at the pre-seed seed stage level? Taylor, take it.
I'll actually speak for like previously being a predominantly seed investor. Now I am a multi-stage investor. As a seed stage investor, ultimately it was a combination of what check size do we write as a fund, and what multiples and exit opportunities do we think this fund can get to, and does that return the fund and or more? And so ultimately, at the end of the day, the like art and science is, okay, we're probably not going to dilute this founder in this round more than 20%. We want to write a check of X size. Can we see, like when we look at the public multiples of this company, if that's a 10x company, do we believe that they can get to $200 million in revenue and trade it and be a $2 billion outcome? And so if you're writing $500,000, $1 million checks, like that was like really how we're thinking about it, less about like ultimately where the business is from a revenue standpoint or is from like a pedigree. Ultimately, like that's driven by market competition. And like larger funds are doing that same math, but with bigger dollars. And so if you want to get into the best deals, you still need to compete with larger funds.
Nihal, quantitative approach?
Yeah, I used to think that there was a negotiation. There really isn't. It's just based on your round size, for pre-seed and seed. So you're raising $2 million, you can delete your company by 20%. It's a 10 post. That's how we think about it. Very simple. How much are you raising? You're raising $5 million, you're looking at 20, 25 post, right? Of course, competition will ultimately drive the prices up, but even repeat founders, serial founders know that 20% is like standard. And we don't really negotiate much on that.
Jason, what's your quantitative approach here?
Yeah, I mean, obviously very similar, and I would be lying if I said there's a model, you could throw it in and get a number out on the other side, but we do put extra weight on. So when we assess things, we first look at team, the market, the product, and then the deal itself. And so I do put extra weight on how valuable I think this team is that they've assembled, how big I think and addressable this market is, and then ultimately how much of this market that I think this product can capture and how much can it substitute within that market. And so I think while yes, we follow a very similar kind of high-level back-of-envelope math to it, we put extra weight on those three variables as well.
But will you ever do the deal if if the founder didn't, like you didn't like the founder and the market wasn't big?
I would never do a deal if I didn't like the
Yes.
founder, no.
Behavior.
So the
Yeah,
first
yeah.
are defective.
Yeah, in that case, the valuation's zero, right? Like, we're not doing the deal.
Yeah, well, true.
Yeah, I would say that I definitely agree with Taylor and Nihal in terms of their approaches. But I would say that I think sometimes you do have to run a returns analysis. So like for instance, last year at the fund I was working at previously, a celebrity founder came who has like over 100 million followers on Instagram. And she was like, oh, for a pre-revenue and pre-product startup, I want a 120 million post-money valuation. And so like with those types of things, I think it's definitely very important to like run the numbers and see like what type of revenue this company needs for us to be able to get like a 20x cash on cash return. So I think, yeah. But I really like Taylor's approach. Bad deal. That's like the same thing I do, so.
Let's open up the polls. Any wild card approaches? I mean, anything outside the ordinary here?
I think people would be making it up if they told you they had some like fully quantitative way to do it.
Go ahead, Nihal. You got. By the way, two people are getting cut, so feel free to jump in and try to steal the point. But go ahead.
Yeah, exactly. We do a 1,000x ARR. No, it's absolutely not. But the thing that does slide up and down if you have a super experienced founders is the round size, like pre-product, pre-launch. So the dilution's still the same. We just did a unicorn founder in New York, and she came back for her next company, and I was like, oh, let's do 2 on 10 posts. She's like, no fucking way. But same dilution, let's do 10 on 50 posts. So we didn't lead that, but we did a supporting check. Same dilution, but she could command a much bigger round size, which I thought was interesting. Same, dilution didn't change.
Last words here. Last words before Tyler tells who's gone.
I think everyone's voted already, no?
You're just trying to get out of here. We're trying to get a show at Google, by the way. So maybe we should vote for you. Should have said that before, right? The event space. Tyler, who's making the finals?
We've got Taylor in the hall moving forward.
Taylor in the hall. There you go. Jason, you got to move over. You're good. You're good. Yeah. No, move to the center. Yeah. The hall, you're moving center. There we go. All right, so two VCs on the outside. You guys are gonna help me out with the banter. So
I think I'm the most final. I have the most finals visits,
most losses, yes.
but I have the most losses in the final.
Yes.
Like LeBron James. Thank you.
No, Mac wins the most. He loses the most. But he gets to the finals, yeah. All right, so
I'm the biggest loser.
you do have a belt, though. You do have a belt. Taylor's looking for it, though. All right, so what's going to go on? 3 questions. We're going to open up the poll at the end. So we're going to let them answer. You guys are going to help me with a little bit banter, maybe get at them a little bit. But let's jump in to the finals. All right, here we go, finals. While established fund managers are still flush with plenty of cash, according to PitchBook data, it shows that emerging VCs are struggling to close their funds. What are key strategies for up-and-coming VCs closing their funds? Taylor, start it off.
While unlike these two, I have not started an emerging fund at one point in my career. I don't know if it's ever easy to start an emerging fund. Like, I've seen people do it, and it's hard. It's a grind. You have to meet a ton of people. You go through different phases in fund life cycles where you go from like individuals and family offices, and then move up the stack to more institutional funding. Like, at each step, that's hard. I think that more institutionalized funds, like fund investors, will probably be more conservative and go to funds that have like long-term returns. But I do think there's still a big opportunity, especially among diverse groups, among female led emerging fund managers, to continue to build pockets of being able to invest in diverse founders, in female founders, because at the end of the day, ultimately at those pre-seed and seed funds, like that's, as we look up the stack, why we're seeing more men being funded is like they're more funded at the pre-seed and seed stage. And so that's like, I think that like resourcefulness was always key to raising those funds. Talking to every person you know, going to established funds, seeing if they will be anchors to your funds. So we've seen that with funds like Left Lane that emerged out of Insight, and getting an anchor LP to come in on that. Once there's an established name on the door, then everyone else will follow. And so being resourceful to get that initial anchor is you got to do everything you can, and sometimes that is inner circle, and that's banging down doors for people to take your calls.
Nihal?
Yeah, I think we're LPs in almost kind of 50 funds. A lot of funds are getting closed right now. A lot of fund ones are getting closed right now, but none of them are generalist funds. And so I think more than ever, to differentiate yourself today, you need a specialty. And your specialty could be, I'm going to focus on underrepresented founders, right? You have Female Founders Fund or Harlem Capital. Your specialty can be prop tech. You have Metaprop. Your specialty can be climate tech, lower carbon, although Saka didn't need any help fundraising. So I would not start a fund one generalist fund today. You will be fucked. You will not raise your fund. Now, ENIAC is generalist, but we started very specifically in mobile, 10 years ago, and that was our wedge, and that's how we kind of built our brand, built a portfolio of great companies, and then it enabled us to become more general. But you start a fund today, you got to have a specialty. That's it.
Dahavia, I'm going to give you and Jason 30 seconds. Only 30 seconds, but should you jump in, questions, comments, or whatever you want to do?
Questions? Do you want questions?
No questions. Any tips, insights?
I mean, having done this for the last 15 months, I think first and foremost also just being able to point to an actual portfolio, even if it's not your actual fund portfolio. So either your angel portfolio or even startups that you've been scouting on your own and haven't been able to invest, but you are able to do the due diligence on them. Being able to say, here's my portfolio of 20 companies that if I had the capital, I could have made you this X return off of, and being able to actually point to the amount of money that the LPs would have been able to make has been incredibly instrumental for me. But
that FOMO. Dahavia, what do you got?
Yeah, I have also never raised a fund. I'm getting into it, but I would say that from the fund managers that I've spoken to, when we think about the past 2 years, there has been a huge growth in the number of emerging managers. And what they're seeing in the market right now is that it's extremely competitive to raise capital, because the LPs that you typically go to for your first fund, they just have so much top of funnel, so many funds at top of funnel, and it's just like very hard to differentiate. And so I think getting creative in terms of like seeking out LPs, I think that can be very important.
All right, we're moving on to the next question. VCs have many thoughts on the perfect fund size to serve early stage startup investing. What do you think the ideal amount to raise a seed stage VC firm would be? Nihal.
The size of ENIAC's fund is the perfect amount. No, well, we actually do it top down and bottoms up, but at the end of the day, smaller funds end up performing a lot better because you can return them a lot easier. The difference between returning a $100 million fund and a $200 million fund are like 3 additional unicorns, so that's not easy. So we keep our fund sizes small, smallish, 100, fund 5 is 125. And the best people in the business do that as well. Fred Wilson, USV, Josh Koppelman, first round, their funds are always around the same size, for a reason. And by the way, 10x DPI on those funds, 10x return, the GPs are completely aligned with the LPs in that scenario. The other thing is we don't get fat on fees. We're not some people like Andreessen, shots fired, who have like 5 billion AUM, I don't know what it is, right? And so, what is that? 28 billion AUM. So, take 2% of that a year, and this is why they have 400 people on staff, and this is why they have crazy offices that nobody goes to, and it's just not efficient. And then you have different incentives. You're motivated by like your paycheck and not your carry. So, keep your fund small.
Taylor, what do you think here?
Totally agree on top down, bottom up. I think power laws matter in venture investing. Like I think that that is just like truth at this point. If you look at the data, and to get to power laws, like usually you have 3 to 4 investments that drive returns of your fund. For us, like we do that on like a 30 to 35 deals per fund basis to be able to get to power laws. Ultimately, your fund size relates to how big those checks you want to be. So right now we're writing average checks of $7 to $8 million on a given check. That's seed through like an early B. At the end of the day, we saw in the last cycle that most Series A's were in the $15 to $20 million range, and that became hard to fight on. So it's ultimately like what is the right check size that gets you that ownership. So if you believe it will really depend on if you believe that what seed rounds look like in the next fund cycle. Are they back to 3? Are they staying at 5? Are they down to 2? And how much, and can you win on a small check? Box Group has proved that power laws for them works. They write a lot of checks and they write a lot of small checks and they still get into rounds.
Jason's raising a fund right now, correct?
I was gonna let her start first time.
I just, that's important. I mean,
Yeah. I think for the
hype
first time you're raising a fund, I think that's the tough one, right? Where do you draw a line? I think for us, where we decided is like we also want to make sure that this first fund performs and outperforms venture averages if we can, because it matters so much for our reputation to be able to raise fund 2, fund 3, fund 4. And so starting with something that's maybe a little bit more conservative that still allows us to pay our staff, especially the staff that don't get carry, but also isn't too large that we won't be able to deploy it and deploy it into good companies is the calculus that we do. And there are a lot of cool tools out there now that help fund managers with this. One that we use called Tactic, I think, but there are a bunch of cool tools that can help founders.
Also, with small checks, you can at least get in. Like it's like you act like an angel. Like writing a $25K check, you can get into a round. So if you're trying to show returns on your first fund, it's like keep it small, get into power law deals, and return that.
Dahavia, any last thoughts before we move on to the last question?
Yeah, I would just say I don't think there is like a set number for a seed fund just because there are a lot of variables to consider. Like Taylor mentioned, market conditions, which determine like, the deal sizes for like seed or Series A and so forth. And then beyond that, whether you will be like a lead investor or a follow-on investor, that's another variable. Geography, whether you're in New York or Atlanta, So I don't think there's like a set size.
All right. We got a celebrity in the house moving around. All right, we're moving on to the last question, and then we're going to open up the polls. So the last question, what's an unpopular investment trend that you see as a big opportunity Whose turn is it right now? Who wants to take this? I'll just let one of you jump up and take it.
This is counter to even my fund, but I think robotics. I think that like how for all of these like businesses that were margin negative in the last few years that are like, okay, we need robots to do a lot of it and fix a lot of it. And so I think to have a lot of these industries work, we're going to need a lot of automation in hardware. And then software layers will come back on top of them. But yeah.
I'm going to say something extremely controversial right now. Web 2.
Go on.
Web 2 is very unpopular to invest in these days, and that's why all I want to do is Web 2.
Agreed.
We're going to open up the polls. As we open up the polls, Dehavia, do you have an unpopular investment trend that you want to share?
I'm not sure if it's unpopular, but one area that I'm looking at is what is called the ownership economy. So I think like in the past few years, we've seen a large increase in like the number of crypto investors, retail traders, and so forth. And so my thesis is to invest into tools that are helping enable the next generation of self-directed investors. So.
Jason.
No, it's funny, when you asked that question, I wasn't thinking sector, I was thinking more in terms of like process, but something we've been really trying to continue to lean into is this digital first kind of strategy of meeting founders anywhere around the world and not necessarily being limited to who we can have coffee with in person or meet at the Battery in SF. And so really kind of continuing to lean heavily into this digital first future of VC, I think, strategy of how can we meet the awesome founder in Guadalajara or the awesome founder in Lagos without having to actually be limited to who we can be proximal to.
To echo that, one of our associates on our team lives in Bali while he invests. He is was a pro surfer before becoming a VC. He's never met another VC, and he has invested in Grin and Shot Monkey before he's 25. So
Does he have a TikTok?
he doesn't.
Have you seen the TikTok with the two PMs by the pool? Yeah. It's hilarious. I don't think they have jobs anymore anyway. But yeah, it's really funny.
We'll share that in the follow-up email. But we have bigger priorities right now. This belt, it's a beautiful belt. If anybody wants to take a picture, I'm going to pose a little bit with this belt. So this is the belt.
Who do you want to win the finals? No, yeah. Are you following? Warriors?
That's the last question. Who's winning? Who are you rooting for?
Warriors belong in a circus. I'm sorry. Steph belonged to the Ringling Brothers, not in the NBA. Sorry. Taylor, what do you think? I'm going for Boston. I hate both teams, but I hate Boston a lot less. So, Taylor?
I have no opinion because I'm like OG Lakers now and forever.
Okay, good. There you go.
100% the
Kobe Shaq forever.
Well, Tatum is channeling Kobe. You know, I mean, that's what he's trying to do. So,
What do you got, Jason?
I'm a big fan of what Steph is doing for underrepresented founders through Penny Jar Capital, so I'm going to have to say the Warriors. And I will say.
All right, let's go Knicks. We're going to make it one day. We're going to do it. Let's go Knicks. We're going to do it. Tyler, who's taking home the belt? Who's doing the victory speech?
As you said that, another vote came in, and it is...
Last vote. Who did that last vote? It's moving.
So we're the only ones who don't know.
Should we cut it off for 5 seconds?
is this like one of those?
I don't know.
Is this one of those like Hillary Clinton election needles?
We need the big screen.
Does this bring back like 2016 memories?
We still got votes coming in? Oh, man. All right, listen, after party, the Jolly is right down the block.
Is it like the New York Times needle?
I guess that means I have to win. Okay.
I don't like ties.
Really?
We don't do ties here. We don't do ties. We don't do ties. What's one of the questions we like to... One vote came in, it's it. That's it. What is it? Who is it? Who won? Jeez.
Hey,
are people voting twice?
Can you vote? Reshma, can you vote? Yeah,
Back to
vote.
tied. Has anyone not voted? Have you...
You want girls who code. Come on, I know he's your husband.
It's true. Lucas, have you voted?
Who would you vote for, me or her? Your husband or Taylor? Who would you vote for?
Taylor! Congratulations! Unbelievable! Wow! What a turn of events! And we did it. That was fun. Taylor, you have the stage. If you want to make a winning speech, if you want to talk about what you're investing in, anything, go ahead. But stand up, take the stage. It's yours. Congratulations.
Thank you.
Congratulations.
I respect you a lot. She's helping a lot of women get into this space, so that's what matters. When I to be
You
fair,
know Father's Day is next week. You know that, right?
but thank you guys all for coming out today. This was awesome. Personally, I will say what I invest in is I have called what I do investing in reimagining commerce, thinking about the way people buy, sell, exchange physical goods, digital goods, and experiences on behalf of themselves or their businesses. So I think that the way that people use technology is becoming consumerized, and those buying experiences should be for the consumers, whether it's at work or it's at your home. And so that's really what I spend time on. And we invest all around the world and across multiple sectors and stages. So definitely email me about any companies.
Let's before we go to the bar, let's take a little group photo here. You hold up that belt like the champion that you are, and then we'll get to the bar and start drinking.